When a financial titan that manages over $11 trillion speaks, the entire market goes silent. Vanguard isn't just another investment firm, it's the backbone of retirement portfolios across America. But this time, the company isn't preaching patience or long-term optimism. Instead, it's sounding an alarm. Vanguard just released a new report about the future of the U.S. stock market, and what it predicts has Wall Street and millions of retirees feeling uneasy. For decades, the company has built its reputation on calm, data-driven advice. They've been the steady hand guiding investors through bubbles, crashes, and everything in between. So when they say the next 10 years might not look anything like the last, people listen. But here's the twist. This warning isn't aimed at day traders or hedge funds. It's directed at ordinary Americans, the people who worked, saved, and invested their entire lives expecting the stock market to keep delivering. Because according to Vanguard's forecast, that golden era of double-digit returns might be over. And for retirees depending on their portfolios to survive, this isn't just financial news. It's a wake-up call. Something big is shifting in the market, and the question everyone's asking now is, why would Vanguard, of all companies, issue such a stark warning? But before we answer that, you need to understand who's delivering this message, and why it carries more weight than almost anyone else on Wall Street. To understand why this warning matters, you first have to understand who's giving it. Vanguard isn't some flashy Wall Street name chasing headlines or quick profits. This is the same company that invented the index fund, a concept so simple yet powerful it changed investing forever. Their mission was never about hype. It was about helping ordinary people grow wealth quietly, predictably, and safely. Today, Vanguard manages over $11 trillion in assets, representing the hard-earned savings of millions of Americans, teachers, engineers, small business owners, and retirees. It's the quiet giant that powers nearly every 401k plan and retirement fund in the country. So when a company built on long-term stability suddenly issues a warning about the next decade of returns, people take notice. This isn't fear-mongering. It's not market noise. It's a data-driven forecast from the most conservative voice in the financial world. Vanguard's analysts have access to decades of historical market data. Every cycle, every bubble, every correction. They're not trying to predict next week's headlines. They're mapping out the next 10 years. And what they found this time isn't the reassuring message retirees were hoping for. For nearly a decade, investors have lived through an unprecedented bull market, fueled by low interest rates, easy money, and record-breaking corporate profits. But according to Vanguard's latest projections, that party might be winding down. The question is, how bad could it get? Vanguard's latest report doesn't sugarcoat the truth. The firm expects U.S. stocks to deliver annual returns of just 3.3% to 5.3% over the next decade, a far cry from the 15% average investors enjoyed since 2015. Think about that for a second. If you've spent years planning for retirement based on the market's past performance, this projection isn't just disappointing, it's alarming. Because those extra percentage points aren't just numbers on a chart. They represent the vacations you planned, the home you hoped to retire in, the security you thought you had. Even more unsettling, Vanguard's outlook for growth stocks, the kind that fueled much of the market's success in the past decade, is even worse. They're projecting returns of just 1.9% to 3.9% annually. That's barely keeping up with inflation and dangerously close to the 4% withdrawal rate retirees rely on to fund their expenses. For millions of Americans who built their nest eggs assuming steady growth, this is like hearing that your lifelong financial roadmap might suddenly stop working. And that's not just speculation. Vanguard's analysts are basing this on years of data showing that markets tend to cool off after long periods of outsized gains. In other words, the incredible run of the 2010s and early 2020s might have already borrowed returns from the future. But that's not the whole story. There's something deeper going on here, something that explains why Vanguard believes the next decade could be one of the toughest in modern investing history. So why is Vanguard, the calm, data-driven giant of the investment world, suddenly sounding the alarm? The answer lies in the massive shift happening beneath the surface of the global economy. For the past decade, the U.S. stock market has been fueled by cheap money. Near-zero interest rates made borrowing effortless. Corporate profits soared, and tech giants dominated with unstoppable growth. But now, that era is ending. Interest rates have climbed, inflation has reared its head, and global growth is slowing down. The easy money machine that once powered Wall Street has started to sputter. Vanguard's analysts see the writing on the wall. The combination of high valuations, slower earnings growth, and tighter monetary policy means the U.S. market simply can't sustain the same momentum. Stocks are no longer cheap. They're expensive, even by historic standards. And when you start from those levels, history shows the next decade usually brings lower returns. But there's another layer to this story, one that hits even closer to home for retirees. Vanguard isn't just forecasting weaker performance. It's quietly warning that the traditional set-it-and-forget-it retirement strategy may no longer work. The 60-40 portfolio, once considered the gold standard for balanced investing, could now expose retirees to more risk than they realize. It's not just about what's happening in the markets, it's about where the money is going next. And according to Vanguard, that flow of capital is starting to move away from America's once unshakable dominance. While most American investors have their eyes locked on the S&P 500, Vanguard's analysts are looking elsewhere, and what they're seeing might surprise you. For the first time in decades, the U.S. may no longer be the best place to grow your money. Vanguard's report points to a quiet but powerful shift. Capital is beginning to flow out of American markets and into international equities and government bonds. Here's why. The U.S. market has been the world's star performer for years, but it's also become overpriced and overcrowded. Investors chasing growth have driven valuations to extremes, especially in the big tech names that dominate the index. Meanwhile, other regions, Europe, Canada, and parts of Asia, are now trading at far more attractive levels, with stronger dividend yields and less risk baked into their prices. Vanguard predicts that developed markets outside the U.S. could deliver 5.7% to 7.7% annualized returns by 2035, potentially double what American stocks are expected to yield. That's a huge wake-up call for anyone still clinging to a U.S.-only investment strategy. And it's not just stocks. The report suggests that U.S. Treasury bonds, long dismissed as boring, could actually outperform growth stocks in the coming decade, offering 3.8% to 4.8% annualized returns with far less volatility. If that seems upside down, that's because it is. We're entering a period where safety might pay better than risk, and global diversification could be the difference between comfort and crisis for retirees. But here's the twist. While these numbers sound grim for the U.S. market, Vanguard's message isn't one of doom. It's a warning, yes, but also a roadmap for those willing to adapt before it's too late. For retirees, Vanguard's warning isn't just about numbers, it's about survival. After decades of being told that stocks always go up, many Americans have built their entire retirement plans around U.S. equities. But if Vanguard's forecast holds true, that strategy could soon backfire in a big way. Imagine retiring today, expecting your investments to grow like they did over the past 10 years, only to see your portfolio crawl forward at 3% a year. That's not growth. That's stagnation. And when you're withdrawing 4% annually to cover living expenses, you're not just standing still. You're sliding backward. This is the silent danger Vanguard wants retirees to recognize. The risk isn't a market crash. It's the slow erosion of your wealth over time. High inflation, low returns, and over-reliance on one market can quietly eat away at the nest egg you spent a lifetime building. But there's still hope. and it starts with diversification. Vanguard emphasizes spreading your investments beyond U.S. borders and into a balanced mix of bonds, international equities, and stable income assets. Not because it's exciting, but because it's smart. In uncertain times, safety becomes the new strategy. Retirees who adapt early, who rebalance, reduce risk, and broaden their exposure, could not only preserve their wealth, but position themselves to benefit when the next global growth cycle begins. As Vanguard puts it, the key isn't to panic, it's to pivot. The old playbook of chasing American stocks is losing its edge. The new one is about balance, discipline, and looking beyond the familiar. When a trillion-dollar institution like Vanguard speaks, the financial world listens, not because it's loud, but because it's measured. Vanguard isn't known for hype or fear-mongering. It's conservative, data-driven, and slow to change its tune. So when it issues a cautious forecast about the next decade, that's not noise, that's a signal. The real message behind this report isn't just that returns may shrink. It's that the entire foundation of how Americans invest could be shifting. For years, investors believed the U.S. stock market was untouchable, the ultimate safe haven for wealth. But Vanguard's analysis suggests that this era of dominance may finally be giving way to a more balanced global reality. This doesn't mean America's markets are doomed. It means they're maturing. Growth that once came easy now requires strategy. Gains that used to come naturally will demand patience, discipline, and smarter diversification. And that's why Vanguard's warning hits so hard for retirees. It's not a prophecy of disaster. It's a reminder that the biggest risk is staying comfortable while the world changes around you. For everyday investors, that means asking new questions. Am I relying too heavily on one country's economy? Am I prepared for a decade of slower growth? And most importantly, what can I do now to protect my future? Because while the forecasts may sound grim, the truth is this. Every market shift brings opportunity for those who move first. The next decade won't look like the last, and Vanguard's report makes that clearer than ever. For investors, especially retirees, this is the moment to act before the wave hits. The smartest investors aren't panicking, they're positioning. They're shifting from overvalued U.S. growth stocks into undervalued global markets. They're adding steady income sources like treasury bonds and dividend-paying international equities. They're not chasing hype, they're building resilience. This is what adaptation looks like: quiet, calculated, and intentional. The world's biggest money managers know that the real danger isn't a crash, it's complacency. Those who wait for things to go back to normal may find that the old normal isn't coming back. Vanguard's warning isn't just a prediction, it's a challenge. A challenge to think globally, to manage risk wisely, and to redefine what wealth preservation means in a changing world. The 2020s won't reward the reckless, but they will reward the prepared. So if you're watching this wondering what to do next, start by asking yourself one question. Am I invested for the past or ready for the future? Because in the markets, just like in life, the future doesn't wait. If you found this breakdown helpful, hit like, subscribe, and turn on the notification bell for more deep dives into market trends, financial strategies, and wealth insights. The world of investing is changing fast. Stay informed, stay prepared, and stay ahead.